Credit scores. Just 3 digits, yet they hold incredible power over your financial life. These numbers can influence whether you get approved for a loan, the interest rate you'll pay, your ability to rent a home, and in some cases, even whether you land a job. But what exactly is a credit score? How is it calculated? And why does it matter so much? Today, we're going to dive deep into the world of credit scores and explain their true financial impact. At its core, a credit score is a numerical representation of your creditworthiness. In simple terms, it's a measure of how likely you are to repay borrowed money. Lenders, landlords, and even some employers use this number to assess risk before making decisions. The most widely used scoring model in the United States is the FICO score, which ranges from 300 to 850. The higher your score, the better you look to lenders. Scores are grouped into categories. Below 580 is considered poor, 580 to 669 is fair, 670 to 739 is good, 740 to 799 is very good, and 800 or above is exceptional. But how do they come up with this number? It's not random. The FICO score is built from 5 major components. The first and most important is payment history, which makes up about 35% of your score. This factor examines whether you've paid your bills on time. Even a single late payment can cause a noticeable drop in your score, and the more recent the missed payment, the more damaging it is. Consistency here is key. The best way to build a strong score is to never miss a due date. The second component is amounts owed, often called credit utilization, which accounts for 30% of your score. This measures how much of your available credit you're currently using. For example, if you have a total credit limit of $10,000 and you're using $3,000, your utilization rate is 30%. Most experts recommend keeping this number below 30%, and the lower, the better. The third factor is the length of your credit history, which makes up 15% of your score. This doesn't just look at when you opened your first account, but also the average age of all your accounts. The longer your history, the more data lenders have to evaluate your reliability. This is why keeping older accounts open, even if you don't use them often, can help your score. The fourth factor is credit mix, worth about 10%. Lenders like to see that you can handle different types of credit, such as credit cards, installment loans, auto loans, and mortgages. A healthy mix can be beneficial, though it's not as critical as payment history or utilization. Finally, there's new credit, also at 10%. This considers how many new accounts you've opened recently and how many hard inquiries have been made on your credit report. Opening several accounts in a short period can signal financial distress and may lower your score temporarily. Now that we know how a credit score is calculated, let's talk about why it's so important. One of the biggest reasons is cost. A higher credit score can mean lower interest rates on loans and credit cards. Over time, this can save you thousands of dollars. For example, let's say you're buying a home with a $300,000 mortgage. If you have excellent credit, you might qualify for an interest rate of 5% instead of 7%. Over a 30-year term, that difference could save you well over $100,000 in interest payments. Your credit score also impacts the types of financial products you can access. With a high score, you may qualify for credit cards with generous rewards programs, higher limits, and better perks. Insurance companies in many states use credit-based insurance scores to help determine premiums. Landlords often check credit before approving rental applications, and in certain industries, employers may review your credit report during the hiring process. It's also important to clear up some common myths about credit scores. One popular myth is that checking your own credit score will lower it. This is false. When you check your own score, it's called a soft inquiry and has no impact at all. Only hard inquiries, when a lender checks your credit as part of an application, can temporarily affect your score. Another myth is that you have just one credit score. In reality, you have many. Different credit bureaus, Experian, Equifax, and TransUnion, each keep their own records, and different scoring models may be used depending on the lender and the purpose. Some people also believe that carrying a balance on your credit card helps your score. This is not true. Carrying a balance only means you'll pay interest, which benefits the lender, not you. Paying your balance in full every month is the smartest way to keep utilization low and avoid unnecessary charges. If your credit score isn't where you want it to be, the good news is it can be improved over time. The most important step is to pay all your bills on time, every time. Reducing your credit card balances will also have a significant impact. Try to keep your utilization well under 30% of your total limit, and lower if possible. Avoid applying for too many new accounts in a short span, and keep old accounts open to maintain a longer credit history. You should also check your credit reports regularly. In the US, you're entitled to a free report from each of the 3 major bureaus once a year through annualcreditreport.com. Reviewing your reports can help you spot errors or signs of identity theft. If you find incorrect information, dispute it immediately. Removing inaccurate negative marks can boost your score quickly. It's worth remembering that building a great credit score takes time and consistency. There's no overnight fix, but small, consistent actions add up. Think of it as building your financial reputation. One on-time payment, one low balance, and one responsible decision at a time. A good credit score is not just about saving money on loans. It's about creating options for yourself. It gives you negotiating power, access to better products, and peace of mind in knowing you can qualify for what you need when you need it. On the flip side, a poor score can limit your choices and make life more expensive. In the end, your credit score is a powerful tool. Treat it with care, and it can open doors to a better financial future. Ignore it, and you may find yourself paying more for everything from car insurance to a home loan. The good news is that you have control over many of the factors that influence your score. Pay on time, manage debt wisely, keep tabs on your credit, and over time, your score will reflect your responsible habits. So the next time you think about credit scores, remember, they're not just a number. They're a reflection of your financial health, your habits, and your trustworthiness in the eyes of lenders. Protect it, grow it, and use it to your advantage, because in the world of personal finance, a strong credit score isn't just nice to have. It's essential